In a world of twisted facts, alternative narratives, corrupted corporations, and hacked feeds, how can we decipher the difference between truth and fiction? It's time to take back the truth. Read Robert Kiyosaki's Fake and learn the signs to recognize fake money, fake teachers, and fake assets. Determine what's real in a world where falsehoods are a weapon. Don't let fake advice destroy your financial future. Visit TheRealKiyosaki.com to read Fake by Robert Kiyosaki. That's TheRealKiyosaki.com.
This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Hello. It's Robert Kiyosaki, the Rich Dad Radio Show. The good news and bad news about money. So the big question is for all you real estate fans or just want to get more information about markets right now. Is this 2006 all over again? You know, if you've seen videos of me, I'm standing in LA telling people it was all coming down because being more of a real estate guy than a stock guy, I could see it coming down. You know, when idiots are buying properties, you know it's going to come down. So the question is this 2006 again? And, you know, right now, I always hear it on CNBC, Bubble Vision. Is it time to jump in? So a lot of people are jumping into the residential real estate market. And one reason is because interest rates are going up. So many mom and pops are saying, it's about time we buy a house and, you know, take care of the kids or move to the suburbs or whatever they do. But there's also commercial real estate or investment real estate. So we're going to be talking about all three subjects. It's, you know, residential, mom and pop real estate, but also commercial. What is the overall market doing? So we have a very special guest today. It's a Rich Dad advisor, Kim and my partner for I don't know how many years now. We have made millions and millions and millions together. And Kenny is the author of the ABCs of Real Estate Investment, the ABCs of Property Management, the Advanced Guide to Real Estate Investment. His website is mccompanies.com, and he is one of the most popular advisors we have because a lot of people are interested in property. So, Kimmy, what do you want to say about Kenny?
Well, Kenny has been our partner for many, many, many years, and we've done many thousands of units together. And I remember the three of us talking, and it was 2006. And we're like, and that was when everybody was not renting. So many people were not renting because I remember Kenny saying, you know, we had somebody apply for a $600 rent, and they couldn't qualify because they had bad credit. But then they went down the street and they bought a house for nothing down, no interest for a year, and now they're homeowners, and next thing you know, they're upside down. Yeah. So when you say 2006, it was like, yeah, this is a great time to get into real estate, but where are we in real estate?
And, you know, I remember getting into certain fights with them. You know, people had been renters all their lives. And the thought of the American dream, you know, the dream house in the suburbs, I'm going to not be a renter, I'm going to buy. And I just got into total battle. I said, you buy that thing, you're gonna go under. No, it's not. Real estate always goes up in value, you know.
But it was the lenders that were lending to people who really couldn't qualify for these mortgages. So no surprise they couldn't pay their mortgage.
and today they're called subprime loans or derivatives. So the real estate market didn't really crash. What crashed was the investment market, the derivative market. And back in 2007, there was $700 million in derivatives. Today, there's 1.2 quadrillion. 1.2 quadrillion. That doesn't suck the air out of your lungs. I don't know what happens. What's wrong with you? But people are running into the real estate, especially residential right now. They're buying. Even in commercial, they're buying. They're offering ridiculous prices for properties that make no sense. So the question again, is this 2006 again? Should you be jumping in? You know, the real estate classes are filled all over the world. People are excited, learning how to be property investors, you know, not only homeowners, but be investors, learning how to syndicate and do the advanced exotic investment strategies. So we have our very special guest. He is really, really for real. He's a real teacher. He's a real investor, and is a great friend and partner, Ken McElroy. So, Kenny, are you jumping in right now or jumping
Que
out?
pasa? Que pasa?
Hey, great to be on the show. Thank you.
Thanks, Kenny.
No, actually, we let our acquisition guy go for our company a little over a year now, and as we started seeing the signs, and
What signs?
well,
What were
for
the
us,
signs?
they're different than most people. You know, we have a kind of an investment strategy that we follow, which is cash flow, and you know, we wanted to provide a certain amount of cash flow, you know, whatever deal we're looking at. And as those numbers start going down, cash flow starts going down. The reason generally is because the prices are going up. And then also we were bidding on so many things that we were always first, second, third, let's say. We were always in best and final. So before
Big
there was
outbid, somebody wants to pay more.
yeah. So when we're making lots of offers, and you know, back in the day, you know, back in the early, let's say 07, 8, 9, 10, we were the only bidder, and then in the early, you know, say, you know, 10, 11, 12, there were lots of bidders, but we were always first or second or third. And then, you know, a few years later, we were last, you know, or second to last or near last. And so the what that told us is that, you know, the prices and, you know, interest rates were going up and prices were going up and all that kind of. So we were losing
But
lots
rents
of
were
bids.
staying the same.
Rents, yeah, generally rents were increasing, though, a little bit in a lot of markets at that time. But essentially, the bottom line is that we weren't going to be able to deliver the returns to our investors. And so we said, hey, we think that it's time to sit back and not buy while this frenzy's going on. So that's where we are now.
So who is buying? Who's paying all
Wait,
this?
one quick question. What size properties are you looking at? Because some people might think it's, you know, a 2-bedroom, 1-bath condo in Detroit.
Yeah.
What size are you looking at?
Well, so everything we're looking at is, you know, between $10 and $30 million each.
How many units generally in that?
150 to 300 units per offer.
Okay, good. So, go ahead.
So who is paying these high prices? Who's buying today? I mean, and they're obviously not going to be getting the cash flow that we're used to getting.
Yeah. So, well, it's interesting. You know, everybody has a different theory on what's going on. My partner Ross and I, we believe that the market is peaking or it's peaked. But what we're seeing,
And when you say the market, are you talking national market?
I
Really?
am. I'm talking about for multifamily, at
Okay.
least for what I do. And,
Okay.
and you know, I have a different spin on housing too, but I also think that's peaking in a lot of markets, but single family. But on the multifamily, you know, we're seeing a lot of new groups. You know, we listed 10 properties, as you guys know, back in May.
Which we rarely do.
Yeah, right. We hardly ever sell.
Yeah, we don't like
Yeah.
to sell.
But they're problem properties. You know, they were properties that were tough management properties. You know, and sometimes when you're buying a lot of stuff, you know, there's always your bottom 10, right? Always. And so we decided that we would see what kind of prices we could get, and we put them out unpriced, actually, if you can believe that. So we listed them with a big national company here, you know, very well worldwide recognized company. Went out in July. We had 30 confidentiality or 300 confidentiality agreements signed.
So that means 300 separate buyers said, I'm interested.
Yes, So it went to thousands of people, and 300 people got all the information. Out of that, we had 45 offers.
Wow.
So we had an incredible amount of interest on the 10 properties that we actually didn't even want. And they're all in escrow now for various prices with different people. And at really high numbers. I mean, Ross and I, my partner, were like, geez, we should exit these if we're getting these kind of numbers.
Yeah. And there's a strategy you have already for the investors that are invested in these properties, because we don't like to take our cash out.
Yes. Yeah, we're rolling that into a 1031 tax deferred exchange, and then we have some others in mind. Yes.
So what are some of the problems that were not fixable, or that just kept persisting?
On the ones that we owned?
Ones that we're
Yeah,
selling?
so two of them, for example, were really small. So we bought a portfolio.
How big is small?
Well, small's under 100 units. So when you're under 100 units, your operating expenses are higher, and you can only staff it with 1 or 2 people, and you're not open all the time, and it's just they're tougher management. Anything under 100. So that was a couple of them. A couple more were we bought from a bank that they were real estate owned or REO, owned by the bank, and they were in bad conditions and bad markets, and we probably shouldn't have bought them. But we got them for hardly anything. So we're still going to make a lot of money on them, but they're heavily management, heavy management.
So those who may not understand this thing is we make money. It's called capital gains. The trouble with capital gains is taxed. So our job now is to not pay tax on the gains. Is that correct?
That's exactly right. Yeah. So what we're trying to do is just like anything. I mean, just think of it as somebody who owns 10 houses. There's for sure the very best house and the very worst house, right? Yep. There's always a place that's harder to rent than another. There's always an area that's harder to rent in than another, and there's always.
You mean North Carolina?
Well, you know what I mean. So it's just the same thing, Just taking a look at. We just happen to have, it happens.
Yeah, I was going to say the same principles apply and the same lessons apply whether you own one house or two single-family homes,
right? It's just
owning thousands of units. It's
the
same.
I mean, everybody has multiple investments, and some do really well, and some don't, and so these are the ones that they're doing okay. But we're like, you know what? Once the market turns a little bit, we're a little concerned, and we're gonna see what kind of prices we can get.
So we hopefully sell. Not hopefully, but we're selling because we make more money selling than we do holding on to them.
Right. Well, you gotta. There's not to get.
We make more capital gains than cash flow.
Right.
Okay,
there's an industry term called cap rate or capitalization rate, and these cap rates are as low as they've ever been.
What does that mean?
What it means is it's basically the price of the property divided by the net operating income, and so the cap rate is something that everybody watches, and
some people call it in stocks ROI, return on my investment.
Yeah. So the cap rates are really low, and so at the level that we're playing at with these buyers and
so let me just interrupt. So if it's a low cap rate, basically the cash flow is not as great as if it was a higher
buying,
cap rate.
Yeah. So in our case, though, we're sellers, so the cap rates are low. So cap rates are below 5% on all of our sales. And so the point is it doesn't really matter how well we perform on the property operationally. If cap rates go up, our prices go down.
Yeah.
So because
why is that?
We took a look at all of them. We said I went back to the management company. I said, okay, let's say you can increase your net operating income on these 10 deals. Let's say 5%.
And your net operating income is very simply income minus expenses.
Yeah, income minus expenses.
Without debt.
Right. Let's say you can do that. I said, so we ran budgets out for the next 5 years on all 10. And then I said, okay, if cap rates go up a half a point, it's all gone. So in other words, because cap rates are so low, prices are high, and that's good for a seller, not good for a buyer. And so, so the conclusion was that we should not hold these. We should let somebody else that's smarter than us figure these out.
Or not.
Yeah.
Well, just give an example in the stock market. I think some stocks, I don't know how they measure it, but it'll take you 125 years to get your money back. I mean, you don't ever get your money back, and people are chasing it,
Well, I'll just give you an example. Like one of the deals was priced at around $18 million. We actually just sold it on Friday for $18 million. 3 years ago it was 16. And so the question is, if cap rates go up, which they will, over the next 3 years, that could be 16 again. So you're looking at equity.
Wait, I don't understand that. Why is that?
Well, cap rates, the higher the cap rate, the lower the price of the property. That's it.
That makes no sense.
That's the way it works, though.
Yeah,
That's
correct. That's correct.
No, I want my capital gains here.
Yeah, no.
To me, I would rather have a high cap rate property.
Well, that's when you want to buy high cap rate.
If you're buying, you want a high cap rate.
But you want to sell at low.
So let me ask you this, Kenny. You also said the you see that the multifamily is peaking. You said it seems similar to single-family homes too?
Well, I think single-family homes are a little different. Yeah, I just read a really good article about single-family, and most of the markets are at 2006, 2007 pricing.
So they've come back up.
A lot of them, yeah. And a lot of them are really still negative equity, like Cleveland and Detroit and Toledo,
Phoenix.
Ohio. And,
Just give an example in where Kim and I live. This house across the street that at the peak of the real estate boom in like 2000, the house sold for $4 million. And it just sold a year ago for $1.8 million. So it's lost over 50% of its value. There's no buyers for big houses.
I think what happens to people is they look at the last few years and they go, oh, this house has gone up a couple grand, a couple $100,000, whatever, million. And then they go, it's going to keep doing that.
Yeah.
Where I look at that and I'm like, okay, it's already gone up. So there's no reason to buy it now. And, what's the chances of it continuing to go up like that? So it's just a philosophy difference. People think that it's going to continue over the last few years, and it might, but I'm not going to take that gamble. I'd rather buy in, 2010, 2009, 2011 and wait for the next pop and then
When
buy
it's
again.
at the bottom.
Yes.
So one more, I was looking at another property yesterday. Beautiful, beautiful home. Beautiful home. And the guy had it on the market for 3.8. It's now down to 2.8. And I walked into the realtor and she says it'll go at 2.2. So those are the big houses. Now, my opinion it's beautiful. Swimming pool's ungodly. But a lot of it's because the baby boomers are exiting the big houses, right?
They are, yeah. I'm actually in that same, class.
We all are.
Yeah, no, my kids are. I have one in college. I have one a senior in high school, and he's about ready to go. And I have a big house. I don't need it. And so yeah, I'm looking for.
Yeah, so it might be a good market for those you're looking for beautiful homes with our big McMansions, but there's a lot of people selling right now. So when we come back, we're talking further about, Kenny, how you look at markets, how you value them, some of the differences between residential real estate versus commercial real estate. So this is one of the most important subjects at one of the most important times, because are we at the top of 2006? One more time.
You're listening to The Rich Dad Radio Show with Robert Kiyosaki.
What is your number one expense in life? Your number one expense. It's taxes. And I've asked the question is, how come there's no financial education in school, but why isn't there education on taxes either? They tell you to save money, which is stupid. They tell you to invest in the stock market, which is stupid. But won't they teach you about taxes? So here at Rich Dad advisor Tom Wheelwright, we're talking about his revision for his book, Tax-Free Wealth. Welcome, Tom.
Thanks, Robert.
So what's the Tax-Free Wealth about? What's different this time? It's a revised edition.
Well, so what we did was this is the first major tax reform we've had in 30 years, 2017.
Was 86 was the last one?
86 was the last one, back when I was in Washington, D.C.
So many guys got wiped out because of that tax change.
They did. It wiped out an entire industry, savings and loans. This new tax law is just as big, but in a very different way. It affects different industries. The tax law is always a series of incentives. And the question is always which incentives and which ones apply to me. And so the key to revising tax-free wealth was, what changed so much in this new tax law that we can absolutely take advantage of? Seriously, the amazing incentives. For example, the bonus depreciation, for example, for real estate is unbelievable. You buy a $1 million apartment, get a $300,000 deduction or more the very first year.
So if you want to make more money and pay less taxes like Donald Trump and myself, get Tom's book, Tax-Free Wealth.
Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and Rich Dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
It pays to listen. Now back to Robert Kiyosaki and the Rich Dad Radio Show.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. You can listen to the Rich Dad Radio program anytime, anywhere on iTunes or Android. And all of our programs are archived at richdadradio.com. We archive them for one purpose, for education. We don't sell real estate. We don't sell stocks, bonds, and mutual funds. We don't sell anything. We sell education. And one of the best ways to learn is by repetition. So if you listen to this program again, especially if you're thinking about buying a house or thinking about starting to become a real estate investor, or you're already a very sophisticated and big real estate investor, this program is worth listening to again. And after you listen to it, then listen to it with friends, family, and business associates and discuss. When you discuss, your intelligence and what you remember will go up through the roof. So our special guest today is our partner, Ken McElroy. We have literally made millions and millions and millions of dollars tax-free together. We started investing when the real estate market crashed. We got out just at the right time, but we didn't just get out. We started investing after it crashed, and we invested hundreds of millions of dollars, I say about $300 million, into a market that was depressed as interest rates were dropping. I would love those days again, wouldn't you?
Oh, I would, yeah.
Oh, that was heaven. But for everybody else, it was hell for those who were caught, on the outside. I have so many friends who lost their houses. I went to a little Italian restaurant next door to our house here, and the cooks came out. They said, "We haven't paid our mortgage in about 2 years." I said, "What's happening?" I said, "I don't know. They're just letting us live there." I said, "Well, enjoy it." What else can you tell them? I said, "We paid too much for it because of all the subprime. Everybody was jumping in. Price, that was just location, and price of real estate will always go up." And so the amateurs jumped in. And we're kind of at that point now. So it's like it's 2006 and 2018 again. So Kenny is talking about how he sees the market, where the good markets, where the bad markets. We're not jumping in. We're actually pulling out. We're selling. Any comments, Kim?
Well, it's so funny how fast people forget. I mean, we're talking 12 years ago when the whole thing started to come crumbling down, and 11 years ago, 10 years ago. And people forget, and we're at this frenzy, and we're seeing this frenzy all over the place, and everybody's jumping in. But here's my question, Kenny. Let's say there is a crash. Let's say this is 2006 all over again, and it does come crashing down. What does it look like? What do we do?
Well, I don't think it's going to be like quite the crash that we had. The reason is because back in, say, 05, 06, there were a lot of investor loans. And so a lot of these houses that went back to the banks and were being bought as investments. And so the banks are
they're called derivatives.
They're actually still pretty tight right now. And so what we're seeing, though, banks are lending on primary residences. And so primarily is what I'm seeing mostly. So it's a lot different.
So if somebody wanted to go buy a single-family house as an investment, the banks are pretty tight on that.
Much harder.
Okay.
Yeah, much harder. Back and when we were doing it, because we were, if you remember, we were converting apartments to condos, and we were selling 50 a month per project. I mean, we were rolling. And they were all investor loans, and people would come in and they would throw down 40, 50, 60,000, and they would get a loan no problem, and they lived in LA or Hawaii or wherever, and and then they had somebody manage them. So
there's a lot to be said about real estate being location. Like when the Russians started to run, they ran into New York City, and so did the Chinese. And so did the Chinese run into Silicon Valley, and it's like the Japanese did back in the 80s. They bought Pebble Beach. They bought Rockefeller Center and all this. And so we have a lot of, either Chinese money or Russian money moving in, jacking up the very high-end residential property, like in New York City, like Hawaii. There was a study. Where does $1 buy the least? It's Hawaii. It is the most expensive place in the U.S. to live in. And yet you look at Silicon Valley, low-income housing is now called 125,000. That's low-income housing because the prices are so high. So you showed me a report on New York City. What's happening with the high-end New York City market?
Well, I think you bring up a very good comment there, Robert. I think what happens is people don't pay attention to global things, and the stuff that's went on in Russia and now going on in China with currency. That and it happened in Japan. Remember back in the 70s and 80s. So the rich people look for markets that they can invest in. And they want
to move their money out of their currency.
We look for like Phoenix to Scottsdale. They look for like China to the U.S. It's different. And so they're looking. Even though a lot of people bitch about the U.S., it is the most stable country, and so there's a lot of investment in the U.S. and that's actually driving up real estate prices.
Plus the Trump tax cut, we're a tax haven now. People are moving their money in droves.
That's right.
But what happened to the high end? Because when it crashed, Kim and I wanted to buy this condo on Times Square, and it was really cheap, 2-bedroom, 2-bath. And then it went through the roof about 5 years later. What was your report on New York City now on the high end? Well,
what it said was that in the first half of 2018, that housing prices in New York City went down 31%.
Wow.
So what is your analysis of that?
Well, I think that's a sign. We've seen that in Seattle, we've seen that in Austin, we've seen that in San Francisco, those are the 4 hottest markets in the country. And some markets are still on fire, though. Everybody wants there to be one reason, for the entire country, but it just isn't the case.
Well, when you mentioned Austin, so Robert and I were approached by some friends, and they're working with a gentleman on a business, and the business requires real estate for each of these different businesses, and they wanted us to be the person that buys the real estate, and this is last year, and all we saw. All the studies about 200 people a day moving into Austin. Prices are like skyrocketed. Little tiny bungalows that should sell for like $25,000. We're going for like $300,000.
Oh, how about millions?
Crazy. So we're stepping aside. This is too out of control. Do you see Austin as making this downturn?
Well, I've been in Austin since 2004. And I bought in 2004, and it popped in 2006. So I owned a property through the
boom and the bust.
Through the boom and the bust, and I fed it financially during that time. I kept it. It was tough. It was one of the that's what happens if you buy wrong. And so I know Austin. I own property in Austin. I think what people the issue in Austin, there's a bunch of them actually. There's transportation issues. The freeways are packed and people are moving further out because they can't afford anything in the city. Affordability is the biggest issue in most of these cities, hands down. You can't everything in downtown Austin, or most of the things, are like $3 a foot, which if you a 700-foot 1-bedroom is $2,000, which is a lot of money for people. And so 10 years ago that would have been half.
Oh, I mean renting at $2,000.
Yeah,
okay.
And then the sales. But
so the people that work in the city can't afford to live in the city.
Well, a lot of them can, but most of them are moving out. Yeah, so they're all moving. Down the different corridors that come in.
So that's a good question. Then getting into the demographic of renters today, are you seeing a change there?
Well, it's the same thing. It's exactly the same thing. People rent where they can afford, and so that's what you start to see. You start to see roommates. You start to see things like that doubling up. And that's what's happening in Hawaii. In Hawaii, there's 3 generations in one home. I don't know that anywhere in the country that exists. 3 generations in one household. That is all to do with affordability. That means they can't afford to live anywhere, whether they own it or they're renting. It doesn't really matter. And so the same thing with a renter. If you're making $100,000, honestly, you're probably not living in downtown Austin. If you are, you're basically, you're a show off because you want to say, hey, look where I live, look what I drive. But, really you should be living 30, 45 minutes away and commuting in.
So what advice would you have for, let's say, somebody just starting out? They're now making some money, they have a job, and they're looking at the stock market, they have a 401k. how would they get started in real estate?
Well, there are still markets, believe it or not, that would still work financially. It's just that what happens is the ones that are growing year over year are getting all the hype. And so that's unfortunately what people do. You know, the irrational exuberance, I think it's called, right?
Yeah.
Yeah. So they're saying, oh, well, you know, Scottsdale rents went up 8 or 10%, or Scottsdale home prices went up, 8 or 10%. It's going to happen again. And that's the mistake people get into. But even in Phoenix, the Phoenix area, which there's lots of municipalities that feed into that, there are still good areas to invest in. But they're certainly less strong as some of the markets that are doing really, really well.
So wouldn't, like one of the rules I have is we don't invest more than an hour away from our house because, as you know, it's not the property, it's the property management that's the biggest issue, right?
It's everything, yeah. That's interesting. I agree with that if you're starting out because there's a lot of things. I have friends that have bought all over the place back in the day, when they were buying even cheap houses that they bought for, at 50 grand, 60 grand, 75 grand. They're flying to New York or Florida or Dallas or whatever, and they're not happy, right? Because they got to take a day off of work or whatever they're doing and go down there and, and how much can you really do in a day?
Well, my first property in Maui, I lived on Oahu. I made $25 a month, and every time I had a problem, it cost me several hundred to fly over there plus a day off work to fix it.
That's my point. Yeah. And so, management is so key. You can certainly handle that much easier if you're local. But people do that. They start to buy all over the place, and they don't consider the management. They think it's like a stock. They don't consider the management piece, which is the most important piece. But if you buy in a market that people want to be in, you're going to be fine. That's the key to everything. It's really not that hard.
So even if you're living in Austin, Texas, are you saying that there's still areas around Austin that can be good deals and cash flow?
Yeah. Oh, yeah.
You got to go search them out.
Yeah. But if you look at the interstate between San Antonio and Austin, which is only an hour and a half, there's a San Marcos is right in the center. Everything's growing in between San Antonio and Austin right now because of all of this. It'll just continue to grow all the way down the freeway, and pretty soon San Antonio and Austin will be it'll be like L.A.
It would be part of that whole area. It'd be one big massive city.
One big massive city all the way up and down the freeway. Right now it's just vacant land.
So we come back. We're going to the most popular part of our program, which is Ask Robert. And the reason we know it's one of the more popular parts of the program is we get hundreds and hundreds and hundreds of questions on real estate. And I'll have to shamelessly plug my latest book coming out. It's called Fake. If you're really going to be successful in life, you don't want to be taught by fake teachers. And a fake teacher is somebody who has no idea what they're talking about. So a real teacher is somebody who's in the business of real estate every day. So we've held a lot of the more pertinent questions so Kenny could answer them because Kenny is a real estate investor and he is a real teacher.
You're listening to the Rich Dad Radio Show with Robert Kiyosaki.
Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and rich dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
Log on to richdadradio.com while you listen. Now back to Robert Kiyosaki.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And you can listen to the Rich Dad Radio program anytime, anywhere on iTunes or Android. And all of our programs are archived at richdadradio.com. We archive them for one main reason. One of them is for repetition, but more than you can discuss with. Also, you can discuss friends, family, and business associates, especially property, because there's more misconceptions about real estate, probably than anything, because everybody I know is a real estate expert because they either rent or they buy a house. And really, there's an art and a science and a business behind real estate investing. So our guest today is Ken McElroy. He's our partner and advisor on real estate. He's the founder of MC Companies. We have made literally millions and millions of dollars with Kenny, tax-free, and I emphasize tax-free. Kenny is the author of the book ABCs of Real Estate Investing, the ABCs of Property Management, and the Advanced Guide to Real Estate Investing. If you're serious about becoming a real estate investor, then I would get those books. It costs you $60. But if you're just going to be a homeowner and pretend that your house is an asset, then you don't need to get Kenny's books. Kenny's website is mccompanies.com. One word, mccompanies.com. Please get his books if you really are serious about investing in real estate, because real estate has one big problem compared to stocks. You make a mistake in real estate, you can't get out. You buy it and you're stuck with it. If it's a bad investment, you're stuck with it forever, or you have to discount it. At least with a stock bond, or a mutual fund, if you buy it, you make a mistake, it's liquid. You can get out really quickly. So the big difference between property and stocks is liquidity. How fast can you buy and sell? Real estate is slow, slow, slow. Any comments, Kim?
Yeah, I really want to recommend, if you're just starting out, of course, ABCs of real estate investing, but ABCs of property management. Because when we met Kenny for the first time, he and you and your partner, Ross, were doing primarily property management. And that's where the money is made and lost, is property management. It's not when you buy and sell. It's really how you manage the property. And there's so many nuances to how you make a property work or how a property can fail instantly. So property management to me is the key.
And the Advanced Guide to Real Estate Investing is how we make millions and millions and millions and millions of dollars tax-free. But that requires a lot more sophistication. So you can submit your questions to Ask Robert at richdadradio.com. So Melissa, what is the first question?
Our first question today, Robert, comes from Richard in Cerritos, California. Favorite book, Rich Dad, Poor Dad. He says, I'm watching with alarm the effort to expand rent control in California. I'm curious, Robert, if you, Kim, and Ken have residential rental property in California, and what sources of political information and intelligence do you have on cities and states where you all invest in real estate?
Well, first thing I would do is I would get out of California, but that's just my personal, because Kim and I got out. So, Kenny, what would you have to say for him about California? The big word he uses is two words, rent control. What does that mean?
Yeah. Well, first of all, it's a really, really good question, and it's timely because affordability is kind of the big issue. Renters cannot afford rent, and so they're doubling up, and rent has gone up a lot in the last 10 years. And so what happens when rent goes up like this is there's all kinds of programs like rent control. So rent control essentially is a government policy that controls the amount of rent. That's all it is. And so what it means from a owner is that you can't grow your rent in a market because
it means the government steps in.
Yeah, it's controlled.
Yeah,
and it's it's in New York, it's in LA, and so I think that the people to turn to would be in California specifically would be the California Apartment Association. They have a big lobbying group. This is a hot topic right now across the whole country. And, we're back in Washington, D.C. talking about it right now. The National Multi-Housing Council, or NMHC, is another one. Those are two very good sources that you can get a lot of information on this topic. We're being very, very proactive as an organization.
And a lot of times the commercial brokers like Marcus Millichamp and all that, they have that information if you can ask them.
Sometimes they do, yeah. Sometimes the brokers will have that.
And another reason Robert and I never invested in California was it was very pro-tenant, meaning that the courts always favored the tenant versus the landlord. Is that still the case today?
Yes, that is still the case. So every state has a set of landlord-tenant laws, and those laws are different. And it usually gets sticky around non-payment of rent. If you own something and somebody says they're going to rent your place and pay you rent, and they don't, those laws are very different in California.
I've heard horror stories in California, people taking like 6 months to 8 months to get somebody out who's not paying rent.
Yeah, we would call that pro-tenant, or, there's either pro-landlord or pro-tenant. So it needs to be a balance in between.
And FYI, when people say, well, why are you investing in Arizona? One reason is because Arizona is very pro-owner, not pro-tenant. Those are very big distinctions to be made.
Well, I remember when I was early days and we had our smaller apartments here, and I had to go into court because the tenant hadn't been paying rent. Eviction, yes. And so I went up, and the judge said, okay, so ruled in my favor, and then asked me, she said, how come you let him stay there for 4 months? And I said, well, he's a young father, 2 kids. I was trying to help him out. And she scolded me. She said, we have laws here for a reason. And if they don't pay, they are out. And you need to uphold these laws. And this was Arizona. And this is a judge saying it is about, the landlord has to enforce the rules as well. But she read me the riot act. She was pissed.
And this doesn't happen in California or New York. So those are very big reasons. Next question, Melissa.
Our next question comes from Kirk in Alabama. Favorite book, Rich Dad Guide to Investing. It says, Robert and Kim, with real estate and the stock market being extremely high, what sector are you investing in that generates cash flow in today's markets?
Well, the number one area of cash flow is a business. There's 4 basic asset classes from Rich Dad. Number 1 is a business. Number 2 is real estate. Number 3 is the stock market. Number 4, commodities. And commodities could be gold, silver, oil, and water. And one of the reasons we have Rich Dad advisors is because each one of these things have legal as well as tax consequences. So it's not a matter of just saying, well, what you're looking at. We have a whole advisory team looking at everything we look at before we invest. It's called being a sophisticated investor here. So, Kenny, what are you looking at?
Well, first of all, I agree with you on what you said. It's very, very hard to find cash flow in real estate right now. We're still looking. And actually, Ross and I looked at a deal last week. We're looking at another one this week. So we continue to look. It's just harder and harder and harder to find. I agree with you, Robert. I think businesses are the best thing for us right now.
But you don't just jump into a business either, because that's a whole other bag of worms.
It is. But if you're talking about cash flow and you're asking for a place to invest, I think that starting a business or buying a business potentially and growing it, there's a lot to that, as you know.
Correct.
And, on the other side of it, we have a property. It's a single tenant, and that lease is coming up. And it's been fascinating watching.
It's a large property.
Large property. It's almost 6 acres. It's interesting looking at who's interested and what do they want to put there. And I think what it's coming down to is senior housing. Senior housing is what they want to build versus office versus boutique hotel. Definitely versus multi-housing. Yeah,
there's different levels of senior housing. I'm involved in it. You've got your active senior housing, and then you've got your assisted care.
Newly dead.
Yeah, and then you've got your congregate care as they kind of move along. And so, yes, it's very popular right now, and there's all kinds of financial models around that. And that self-storage is really another area that a lot of people are buying existing real estate and tearing down. There's a lot of people trying different things right now. And
I read I met a guy from Seattle, because a lot of people can't afford to live in Seattle, but they work there. So what he was buying these large 3 and 4 bedroom houses with 3 and 4 baths in them, and he'd subdivide them. He'd turn 1 bedroom and a bath into a little apartment. And so, they'd all move in on Sunday night, and they'd move out Friday afternoon. They'd go home. So he was getting like 4 or 5 times the rent by subdividing one house into renting to 4 or 5 other, part-time renters like business workers. So a lot of it is creativity, but always remember, it's always a business. You got to make money, and you're going to lose money. You have taxes, and you have legal problems. So anyway, you can submit your questions to Ask Robert at richdadradio.com. I want to thank Kenny for your contribution, not only to Kim and our bottom line, but our learning every single day. comments, Kim?
No, I just want to say thank you, Kenny. I always learn so much from you, and so we're going to stay tuned and see what happens. Is this 2006 all over again? And where's the opportunity?
And remember, there's real teachers and fake teachers out there, and Kenny is a real teacher. That's why he's one of our Rich Dad advisors. Thank you for listening to the Rich Dad Radio Show.
hiu hiu trẻ mùa lụt nước lũ bắt cá giữ